Why is gold falling when the world is on fire? The Middle East is on fire. Oil is above $112 a barrel. Inflation is surging. The dollar is strengthening. And by every rule in the financial textbook, gold should be exploding higher right now. It is not. Gold is falling. Silver is lagging. The stock market is on the edge, teetering between fear and paralysis. And Bitcoin is pinned in a narrow range, going nowhere. If that makes no sense to you, good. Because what is happening right now is one of the most misunderstood dynamics in all of financial markets. And once you understand it, really understand it, you will never look at a gold price chart the same way again. This is why gold falls when the world is on fire, and why that might be the best news you have heard all week. Gold has one job in the popular imagination. When the world falls apart, when wars start, when currencies wobble, when banks fail, gold goes up. 5,000 years of monetary history have reinforced it. Central banks hold it, governments hoard it, investors flee to it. It is the ultimate safe haven. So why, in the middle of a genuine geopolitical crisis, is it not behaving like one? The answer begins with understanding what actually happens in markets during moments of acute stress. When uncertainty spikes, professional market participants, hedge funds, institutional desks, leveraged traders suddenly face a very specific and very urgent problem. They need cash. Not in a week, not tomorrow, now. Margin calls are triggered, risk limits are breached, positions have to be reduced immediately. And here's the critical point most retail investors do not fully appreciate. In a liquidity crunch, you do not sell what you want to sell. You sell what you can sell, quickly, at scale. Gold and silver are among the most liquid instruments on Earth. They trade 24 hours a day, 7 days a week, globally, with tight spreads and enormous volume. When a major institution needs to raise $2 billion in the next 4 hours, gold is one of the first things they liquidate. Not because they have lost faith in it, simply because it is there, it is liquid, and it can be sold. But there is a dimension to this selling pressure that goes beyond Western institutional desks. Emerging market nations, countries low on dollar reserves and facing surging oil import bills, are selling gold specifically to secure the dollars they need to pay for energy. When oil spikes to $112 a barrel, a country that imports the majority of its energy faces a currency crisis layered on top of an inflation crisis. Their central banks liquidate gold to generate dollars. That selling hits the market from multiple directions simultaneously, driving prices further down while strengthening the very dollar that is already working against gold. A self-reinforcing cycle. Oil higher, dollar stronger, gold weaker. More emerging markets selling, dollars stronger still. This is the liquidity trap. And it has played out identically in every major crisis. March 2020. Pandemic panic hits and gold drops before recovering explosively. The 2008 financial crisis, gold sells off hard in the initial deleveraging before beginning its multi-year bull run. Every time, the pattern is the same. Forced selling creates a dip that looks like rejection, but is actually a spring being compressed. Beyond a liquidity crunch, there is a second and more sophisticated force working against gold right now, and this one is far less intuitive. Brent crude has crossed $112 a barrel on the back of the Iran conflict. Energy touches everything: transport costs, manufacturing inputs, food production, heating. The moment oil crosses that threshold, the inflation calculus changes for every central banker, every bond trader, and every institutional allocator on Earth. And the conventional wisdom says, energy inflation is good for gold. Inflation erodes fiat purchasing power. Gold preserves it. Therefore, oil up equals gold up. Except that's not what is happening. This is the oil shock paradox. When oil prices surge due to geopolitical shock rather than demand-driven growth, the market reads it as a stagflationary threat. Inflation rising while growth risks increase simultaneously. And that changes everything about how central banks respond. Think about where we were at the start of 2026. Investors were pricing in multiple Fed rate cuts. The inflation fight appeared won. Then, Brent crossed $112. Within weeks, not months, weeks, the market swung from pricing in multiple cuts to pricing in a 50% probability of a rate hike by October. 50% odds of a hike by October. That's a seismic reversal of the entire monetary narrative in a matter of weeks. Traders who had positioned for an easing cycle found themselves on the wrong side of one of the fastest policy repricing events in recent memory. Gold does not pay interest. It does not pay a dividend. It does not generate cash flow. When real interest rates rise significantly, the opportunity cost of holding gold rises with them. Every dollar sitting in gold is a dollar not sitting in a treasury bond earning a real positive yield. As real yields climb, institutional allocators reduce gold exposure, mechanical, rational, happening right now. Layer on top of this a strengthening US dollar. Oil priced in dollars means surging oil means surging dollar demand. The dollar strengthens, and because gold is denominated in dollars, a stronger dollar directly suppresses the gold price for international buyers. The oil shock paradox is complete. The very inflationary force that should be driving investors into gold is actively working against it in the short term through its impact on rates and the dollar. A self-reinforcing cycle. Oil higher, dollar stronger, gold weaker. The very inflationary force that should be driving investors into gold is actively working against it in the short term through its impact on rates and the dollar. And then there's the equity market, which is not rallying. Let's be clear about that. Equities are on the edge. Volatility is elevated. Institutional money is frozen, watching, waiting to see whether this conflict escalates further or finds a diplomatic exit. No asset class is behaving normally right now. Gold is falling not because risk is off the table, but because mechanical forces are temporarily overwhelming fundamental demand. Equities are not surging because confidence has returned. They are holding on by their fingernails, supported only by the hope that diplomacy finds a way through before the economic damage becomes irreversible. This is a market in suspended animation, and suspended animation does not last. Now here's the part of this story that nobody in mainstream financial media will tell you cleanly, because when you lay it out in sequence, it looks less like a market and more like a mechanism. It starts in 2022. The moment the United States froze Russia's dollar reserves, $300 billion of sovereign assets gone overnight with a keystroke, every central bank on earth received the same message simultaneously. Dollar reserves can be seized overnight. Gold cannot. And central banks responded accordingly.
China, Russia, India, Poland, they started buying gold like never before. Not cautiously, not gradually, aggressively, consistently, and at scale. Between 2022 and 2025, central banks globally bought more than 3,000 tons of gold, double their historical pace. 3 straight years of accumulation that built the structural floor underneath the gold price at levels it had never previously held. That central bank buying did something critical. It established a price floor. It created the demand foundation that allowed gold to begin its climb from around $1,800. And it sent a signal to the institutional money that was watching. The sovereign buyers are in. The floor is real. The trade has legs. And that is when the second layer arrived. J.P. Morgan, Morgan Stanley, BlackRock, Citi, they were all quietly accumulating gold while simultaneously publishing research reports telling their retail clients to buy. Read that again slowly. The largest financial institutions in the world were building their own gold positions at the same time they were broadcasting bullish research to the public. The research was not wrong. Gold was going up. But understanding why they were publishing it tells you everything about what came next. Here is the distinction that changes everything. Central banks buy gold to hold forever. It is a reserve asset. It never gets sold. Institutions buy gold as a trade. They need an exit. And to exit at the best possible price, you need buyers, lots of them, preferably ones who arrive late, pay the highest prices, and hold on just long enough to absorb your selling. From 2022 to 2026, gold pumped almost 250% and added $28 trillion to its market cap. 250%, $28 trillion. Central banks built the floor, institutions rode the hype, and then they needed to get out. Then retail arrived, right on cue. Gold went vertical in January 2026. Regular investors saw the numbers. ETF inflows hit all-time records. Social media lit up. FOMO, fear of missing out, pulled in a wave of leveraged longs who chased the price higher. Everyone piling in at exactly the moment the people who bought at 1800 needed an exit. The retail buyer became the exit liquidity, not because of malice, because that is how markets work when you understand the structure. Then, the war started. U.S. and Israeli strikes on Iran on February 28th. Oil supply disrupted. The Strait of Hormuz threatened. Every reason for gold to explode was on the table. Retail thought this was the moment, the confirmation trade, the final catalyst. But since the war started, gold is down 25%. Why did gold fall during a war? Because institutions needed an exit, and the war gave them the perfect cover. The sequence ran like clockwork. Oil spiked, inflation fears surged, rate expectations reversed. Gold lost its appeal as a yield-free asset. Stop losses triggered, margin calls hit, algorithms accelerated the dump. The retail buyers who had chased the January move were now underwater, forced to sell at whatever price the market would give them. The very enthusiasm that drove prices to the highs became the fuel for the crash lower. Central banks built the floor, institutions built the hype, retail provided the exit, the war pulled the trigger. This is not conspiracy. This is the documented structure of leveraged commodity markets. It happened in silver in 1980 when the Hunt brothers' corner collapsed. It happens in oil. It happens in gold, repeatedly, at moments of maximum emotional intensity. Understanding this does not make you cynical about gold as an asset. It makes you a more disciplined participant in the market for it. The question you must always ask when gold is making headlines is this: who is on the other side of this move? And are they buying or are they selling into your enthusiasm? Silver deserves its own analysis because its behavior right now is telling us something important. Silver is not simply a cheaper version of gold. It carries dual demand, monetary and industrial. Solar panels, electronics, electric vehicles, medical equipment. Silver sits at the intersection of the monetary reset thesis and the green energy transition simultaneously. In a pure liquidity-driven sell-off, silver gets hit harder than gold initially. Its market is thinner, its volatility higher, but it rebounds faster when the forced selling exhausts itself. The relative resilience silver is showing through this episode hints at what the market is quietly pricing beneath the surface noise, that the structural demand story, particularly from the energy transition, remains intact. Gold as the pure monetary anchor, silver as the industrial monetary hybrid with asymmetric upside when the cycle turns. Here is what the financial media will not show you while it runs headlines about gold's collapse. The People's Bank of China has increased its gold reserves for 16 consecutive months on the Shanghai Gold Exchange. Not 12 months, not 8, 16 months in a row without interruption through every bout of volatility, every rate repricing, every geopolitical shock. In February 2026 alone, China added approximately 30,000 ounces, roughly 1 metric ton, bringing official holdings to 239 tons, valued at around $380 billion. Gold now accounts for roughly 10% of China's total foreign exchange reserves. That figure has doubled in recent years. While retail investors in the West are panic selling at the bottom, the largest accumulator of monetary gold on Earth is buying every single month without exception. And China is not alone. Indian households currently hold approximately 25,000 tons of gold, more than any central bank in the world. In India, gold is not an investment, it is cultural security, an emergency buffer trusted across generations precisely because every other financial instrument has at some point failed the ordinary person. This is the signal to watch when the noise becomes overwhelming, not the day traders on social media, not the headline about gold falling. The signal is the behavior of the entities with the longest time horizons, the deepest analytical resources, and the most to lose being wrong. And right now, those entities are accumulating. Gold remains a vital collateral asset during periods of chaos. Its recent price drop is a reflection of forced selling mechanics, not a failure of gold as a store of value. The distinction between those two things is everything. One is temporary, the other would be permanent. This is the former. The medium-term outlook for gold comes down to two variables. How long does the Iran conflict last, and does the Fed blink? If the conflict moves towards a ceasefire, the mechanics unwind quickly. Brent crude, currently above $112, would sell off sharply as the geopolitical risk premium, traders estimate $15 to $25 per barrel, begins to unwind. Oil could fall back towards $80 to $90 within days of a credible announcement. Lower oil means lower inflation expectations. Lower inflation expectations mean the Federal Reserve's rate path softens. The 50% October hike probability gets unwound. Real yields fall. The dollar softens. Every headwind working against gold flips directions simultaneously. And here is the counterintuitive trap to watch for. In the first 24 to 48 hours after a ceasefire, gold may actually dip further as the immediate safe haven premium unwinds. Seeing gold fall on peace news and interpreting it as gold failing again would be the wrong read entirely. It's the last flush before the recovery. Within the first month, if the ceasefire holds, a move towards $4,800 to $5,000 becomes not just possible, but probable. History supports this pattern with uncomfortable precision. Gold fell 25% peak to trough in 2008 before launching to new all-time highs. The 17% COVID dump of March 2020 preceded a 50% rally within months. Sharp corrections during periods of acute market stress have, without exception in the modern gold bull market, been the entry points that generational wealth was built from, not the exit points. The question is always the same in these moments. Are you watching price action and reacting emotionally, or are you watching the structural forces that the price action is temporarily obscuring? No analysis of this moment is complete without addressing Bitcoin, because while gold is falling and equities are teetering, Bitcoin has done something different. It has done almost nothing. Bitcoin has been compressed between $60,000 and $76,000 for weeks, not collapsing, not surging, just sitting, tightly coiled in a range that is narrowing with each passing day. And understanding why tells you something important about where it goes next. Bitcoin doesn't have the same institutional liquidation dynamic as gold during a crisis. It's not held at the same scale on trading desks as a liquid collateral asset that gets sold first when margin calls hit. The hands holding Bitcoin right now are by and large strong ones, long-term believers, sovereign-adjacent entities, and institutional allocators who came in through the ETF structures of the last 2 years and are unlikely to sell into short-term geopolitical volatility.
But Bitcoin is also not yet the safe haven asset that gold is. That transition is underway, but it is not complete. When genuine fear grips markets, Bitcoin is still classified in most institutional risk frameworks as a risk asset, not a haven. It does not benefit from the initial flight to safety flows. It simply gets left alone, neither bought nor sold with conviction, which is why the range compression. That compression is telling you something important about market psychology. Macro uncertainty is too high for risk-on positioning, but conviction holders are not selling. The floor is holding because the long-term thesis has not changed. Think of it as a coiled spring. The longer Bitcoin compresses in this range under conditions of macro uncertainty, the more violent the eventual breakout tends to be. History supports this. Every period of extended range compression in Bitcoin's cycle has been followed by a directional move of significant magnitude. What will unlock Bitcoin from this range? One of two things: either a ceasefire and subsequent risk-on return that brings institutional allocators back to growth assets, or a deeper macro deterioration that triggers the next phase of the de-dollarization narrative, in which case Bitcoin, as the non-sovereign store of value that cannot be frozen, seized, or debased, starts to attract the kind of sovereign demand that gold has historically commanded. Either path leads higher. The compression is not a sign of weakness, it is a sign of patience, and patience in this monetary reset is the most valuable asset of all. Let me bring this home. Gold is falling not because it has failed, but because a specific and temporary combination of forces, liquidity mechanics, oil-driven rate repricing, dollar strength, emerging market selling, and an engineered institutional exit are overwhelming fundamental demand in the short term. The smart money knows this. While retail panic sells, China has not missed a single month of accumulation in over a year. Indian households are holding. Central banks across the emerging world are adding. The entities with the most to lose from being wrong are not selling into this. They are buying into it. Everything hinges on how long the Iran conflict lasts and whether the Fed blinks. If oil retreats and rate expectations reverse, gold recovers toward $4,800 to $5,000. The pattern has repeated without exception. It will repeat again. Bitcoin sits patiently in its range waiting for the macro fog to clear. When it does, the breakout will be decisive. The liquidity trap is temporary. The debt is permanent. The de-dollarization is accelerating. The central bank accumulation continues. Gold is not broken. Gold is on sale. And when this episode is studied 5 years from now, this dip will look exactly like what it always looks like. This is what a generational entry point looks like before the crowd recognizes it. If you found this video useful, consider liking and subscribing so you don't miss tomorrow's video. What do you think of the levels we gave? Do you agree? Do you have your own levels you're watching? We'd love you to share your thoughts. Comment below so we can all discuss. At the heart of the new global financial economy will be Bitcoin and gold. If you want to be ahead of the curve and be positioned before the crowd figures out what is actually happening, follow this channel.